Now it's time to welcome our next guest, Jeff Small, president of Arbor Financial Services in Melbourne, Florida, and author of the Amazon #1 best-selling book, Turning Financial Planning Right Side Up. Jeff has over 32 years of experience in the business, and he's also a good friend of the income generation and a very close friend of yours truly. Jeff, thanks for being on the show.
Dave, thank you for having me. It's great to be here.
So, fake is the name of the show. Is there really anything fake in the financial industry? I mean, everything is real. I mean, isn't it exactly what it appears to be, right? I mean, so why are we making such a big deal about fake stuff? I'm not sure I understand.
Well, I think because there's always spin, there's always hype, there's always somebody trying to put their panache and influence from what's really happening in the markets. And I think the media is a great example of that. They overemphasize the short term. They never look at the long term.
Well, and you're a great media guy. I mean, you've been on CNBC, Fox News. Heck, you're the only person I've ever allowed to come in as a guest host when I was on vacation here on the Income Generation. You have lots of experience. So how do you maintain your independence and your lack of bias when it seems like nearly everybody else that's one of those talking heads ends up being a stock market cheerleader?
Well, it's very easy to get spun around and entranced in the financial dogma that I call it of the media. But as an investor or as a financial advisor, you really need to maintain objectivity and try and look for things underneath that will give you an edge in terms of information. And case in point, Dave, there was a great article that came out March 9th where Warren Buffett, the famous Warren Buffett, and Robert Shiller, the famous Nobel Prize winning economist, gave their projections on what the 10-year market return will be on the S&P through 2028. Mm-hmm. And the numbers were really, really bad, so we didn't hear about it in the press.
Well, yeah, that's exactly true. So what helps you maintain, in the 45 seconds we have left in this block, what helps you maintain your neutrality? Is it that you're independent? Is it that you're a fiduciary? What makes it different where it's so difficult, it seems, for all these other folks on television?
Well, what's really different is, the lack of promotion and understanding of what cycle and stage of the markets we're really in. And so if you watch the smartest guys on Wall Street get interviewed that aren't pundits, they will say there's times to turn risk on and there's times to turn risk off. And that's where investors get hurt. They get deluded with the one answer that they always have is always be in the market. And that's not always correct.
Well, and it's human nature that many of us individuals, investors, look for the silver bullet. And I think what you're saying is a lot of the talking heads in the media are too willing to give them that silver bullet, unfortunately. So, Jeff, we need to take a commercial break. We'll be right back in a moment. Stay with us if you can for another segment. And you stay with us, too. We're here with Jeff Small. I'm David Scranton, and this is The Income Generation. We'll be right back. And welcome back to The Income Generation. I'm David Scranton. We're here today with our good friend, Jeff Small, president of Arbor Financial Services in Melbourne, Florida, and yes, author of the #1 Amazon best-selling book, Turning Financial Planning Right Side Up. So, Jeff, speaking about turning financial planning right side up, when I was out of town just a few weeks ago and I asked you to do me a big favor and come in as a guest host, you said, I will under one circumstance, and that is you let me talk about all the artificiality in valuations caused by all the corporate stock buybacks. Why do you put the corporate stock buybacks under this category of fake?
Well, I think you have to look at the history of buybacks. They weren't allowed until Ronald Reagan allowed it back until 1982. And so what happens is if Apple buys back 190 billion of their own shares, they're taking those shares out of the market. Hence, they shrink the number of shares outstanding. So when there's demand in the markets, the share price rises more quickly. So it's a form of artificial stimulus that probably should not be allowed unless actual corporations are allowed to use their cash and not issue bonds to buy back shares.
Okay. So it's kind of a way of artificial stimulus by corporate America. But how about the artificial stimulus going on by central banks around the world? Our own Fed was giving stimulus for a while, and then they were trying to reverse it and pull it back. And it seemed like they did a complete course reversal back to stimulus in the Fed meeting just a few short weeks ago. What's this all about, and what does it mean for us?
Well, I think that the central banks like the Federal Reserve or the European Central Bank or the Bank of Japan have a bigger mission than seeking full employment. Their mission is to prop up asset prices. And so over the last 10 years, this incredible stock market run we've had has been subsidized by many forms of artificial stimulus other than true economic growth. And that mantra will continue with the central banks. They will keep asset prices as high as possible because they want to keep issuing debt to expand the economy, because there really is no economic growth when you have a long-term secular demographic of an aging population, not just domestically, but globally.
So what's the method to their madness? Is it the wealth effect? Is it that, well, gosh, if we can push people up the risk curve and we can have an asset recovery, which is what we've really seen, right? The stock market going up through the moon, that people will feel more affluent. Maybe they'll actually go out and spend more money and stimulate the economy. Do you think that's what they're thinking indirectly?
I don't really. I think their mission has changed dramatically, Dave, and I think everybody's committing a huge oversight in our industry by not realizing the central banks of the world. Their number one concern is to make sure governments don't fail financially, and number two, to prevent a systemic financial breakdown like we had back in 2008 and 2009, when we had many institutions on the brink of failure. And even at that time in Florida, 60% of all the banks were on the verge of being consolidated because they did not have enough to meet their stress tests.
Yeah, well, the problem is we're so far down the road right now with all the stimulus and all the debt and all the fake money that we just hope that everything doesn't end up with a big explosion. I know you and I have had those conversations off air. So Jeff, thank you very much for being part of our show today. We really appreciate you being here. And thank you also for watching, but don't go anywhere. We'll be right back with more here on our last segment of the Income Generation.